Let's talk to Nicole Elliott. She is a private investor and technical analyst, according to my board. Very good morning to you, young Nicole.
Hello, Nick.
Right, 3 thoughts-provoking slides. Let's kick off with the Chinese yuan. I read a headline, it was down 6% this year. And that looks like a doji to me, which would suggest, okay, a little bit of uncertainty. Tell us more.
Yes, well, the reason I've picked this one out today is that tomorrow tariffs kick in on $34 billion worth of stuff shuffled between China and the United States only, just those two. Okay, so 34 billion worth of tariffs coming in tomorrow. And when you're facing a trade war, if you've got any sense, you get your weapons together first, don't you? Right?
Okay.
So already in June, the People's Bank of China has been slashing the bank's reserve requirements to give them more money and more ammo to chuck around the place and sustain Chinese business, right?
Okay.
I mean, classic, fantastic, why not do it? Because there's more money sloshing around and the outlook for interest rates is that they're likely not to go up at all. In fact, they're likely to be cut, because that's the next step you can do in your, toolkit. The yuan has weakened. That's why the yuan has weakened. And they have room to do so, in that we were starting here, the weekly chart you can see, we started at about 6.3 yuan to the dollar, and now we've got up to 6.7. 6 is the strongest the yuan has ever been to the US dollar. So, there's room for manoeuvre here. There's plenty of room for manoeuvre. And yes, we've lost 6% in 6 weeks. It's just been 6 weeks. It's not this year, because the first part of this year. No, well, whichever way you can pick. But you can see that for the first few weeks, we went nowhere. And it's only very recently, in the last, 2.5 weeks, that we've actually done anything. So the move is late June, early July. We've now retraced 61% of that previous strengthening of the yuan. The fewer yuan you need to buy a dollar, the stronger the yuan. We've done that. I think it's time to consolidate here between 6.6 and 6.7 yuan. Let the heat get off the thing, stop people breathing down your neck and then blaming you for being a currency manipulator or some nonsense like that. They're not targeting the yuan, they're targeting interest rates. That's what they want. So get them off your back and then decide what you're going to do next. I think the move that we've seen now in the last 2.5 weeks has put bullish momentum at a record high.
Right.
This is really quite something, in that basically over this century, the beginning since the year 2004, the yuan has done nothing but appreciate against the dollar. So these two moves that we've seen in 2015 and now 2018 are counter to the prevailing trend. They're very much counter moves. And it takes people by surprise, because they're used to this perennial sort of undertow of yuan strength. That's not the case at the moment. I don't think it will be this year, and I probably think it won't be next year either. So prepare for a weaker yuan.
Understood. Okay, so let's move on to 10-year Chinese government bond yields, so 10-year money. Obviously, the yield looks to me as if it's going south, which would suggest the government bonds are going to go higher.
That's right. We've peaked. We've quite clearly peaked there above 4%, having seen yields move up fairly steadily in 2017. That's come to an end, done and dusted. We've retraced just over 61% of previous declines, and now we're on the way down again.
Yep.
Okay, so is this good? Is it bad? Well, here we are at 3.5%. I mean, this is more than the US government pays for 10-year paper, which is 2.86, and a lot more than Britain does too. We're currently paying only 1.3. The government can get away with 10-year money at 1.3% in the UK. So to me, this one's a bit of the outlier, really. It's yielding a lot more than anything you can get in Europe of this maturity. Even Italian paper, it's yielding a lot more. So I would suggest, I'm not sure entirely if for an international investor, but certainly for a Chinese investor, I think there's nice room. And let's not forget that this has been a fairly steady market since we first started issuing paper in 2002. Then it was just a domestic market. Now they're trying to internationalise this market, as it would make absolute sense. But most of the time we've held between 2.5% and 5%. So at 3.5%, we're sort of just below the halfway mark, but I think we could go back down towards the 2.5%. Maybe not 2.5%, but certainly about two and three quarters. I think that's a sort of move, and that's quite a lot of money. It's quite a lot of money that you would make if I am correct.
I know which way I'd be on that chart. Okay, let's wrap up with the Shenzhen index. Now, you told me off air that this is more of the local equities making up this indices. That's a really shabby looking chart, isn't it?
Yes, it's well off of the peak, which was in 2015. And in fact, we've been in a clear bear market since the fourth quarter of 2017.
Right.
So, do you know what I mean? We've already had almost 3/4 of a year of bear moves. So it's not a move that's just started, but it is a move that has accelerated at the end of June. That's what we've seen, an acceleration at the end of June. This week we've dipped to a new recent low and the lowest level we've been at since 2015.
Right.
Now this one is a tricky one in that this is very much China-focused shares, so things like the exchange rate don't have much impact here, but obviously interest rates do. Interest rates will impact the value of these shares. We've also got the move is mature. There's no doubt about it. This drop low is mature, and we are coming to support levels, quite important support levels, between 1,600 and 1,550. So what I'm suggesting here is look for a reversal. I thought we might have had it last week. If you look carefully, we had a little hammer there.
It's been negated.
Yeah. It's given up the ghost this week so far, but then we've got to get through to tomorrow afternoon.
Yep.
And we've got, you see, the US was on holiday yesterday, which has mucked things up a bit in terms of stock market moves and who's leading and who's lagging. I would suggest this one is not leading. Be very, very careful. And look for a reversal. I think it's going to base soon, this one actually, and it is cheap at current levels.
On that note, Nicole, thank you very much indeed.